Welcome back to Morning Trade Live. We've got futures set for a positive open here. Equities trying to firm up and redeem themselves after a rough couple weeks here around earnings and a rising treasury yield. Again, joining us into the bell, Rebecca Walser is the president at Walser Wealth Management. Rebecca, good to have you here and begin a week that doesn't have quite as giant of companies reporting, but should be a pretty important one. What's moving the needle in your mind for stocks right now?
Well, Oliver, I'm concerned that we have this FOMO of the investment bankers and everyone saying that we're going to get a soft landing and making the really retail investor think that everything is fine and just stay the course or even go for the long haul and invest more. And I'm just not seeing that. We're seeing disruption. We know that the Federal Reserve and Jerome Powell has really relied on the strength of the labor market to continue to raise. And what we're starting to see now is that average weekly hour production is being cut. And that is affecting the 4-week moving average of initial jobless claims. And we're starting to see those two actual economic indicators be the same, Oliver, as what we saw in 2008 with the global financial crisis, what we saw in 2000 with the dot-com crisis, what we saw in the 95 area and in the 80s, both in the early 80s and the late 80s for both of those recessionary times. So we're starting to see a shift in the underlying leading indicators of labor, which means that there will be less hours worked, less income, which means that the cost CPI is following always the labor indicators of these average weekly production numbers. And so CPI is going to drop as it has been because labor is actually starting now. Even if you're getting more pay per hour, your hours are getting reduced. And so therefore people will be buying less. There'll be less money in the environment. And Oliver, all of that, I know this is long, but all of that on top of all of the other big economic indicators that show pain to me, the inversion, the length of this inversion. We had one time where the inversion was 110 basis points at the end of July between the 2 and the 10. That is a really big problem. The year over year M2 money supply contraction of 5.8% is a recession depression level indicator. So there's a lot of economic data that just says to me that we're going to have a second half of pain, not a second half recovery, and certainly not this smooth landing that everyone keeps thinking that we're going to get.
It's almost been like the smooth landing is transforming into a bounce back to a degree with the way data have been beating expectations. But it sounds like you're still focused generally on the greater risk of there being recession-like conditions rather than reflation-like conditions.
Yeah, I mean, what I don't want is that we've been very cautious about the recovery of 2022 and expecting really there to be economic pain. And Oliver, there was a lot of liquidity in the system that had to be sort of dried up. And that takes time to get through. And then you have, stuff going on with China and their deflationary environment and problems with them. So the whole world is kind of at a precipice, but yet we've just had to get through all of the extra surpluses that we had. We saw that we started to see in March and April, the banks really drying up. And if you even look at the lending requirements of banks, they have tightened their lending requirements also to recession depressionary levels. That always happens when you go into cost of capital going up, things are a lot tighter, liquidity drying up, and then you see the bank lending standards completely, truncate and get really tight. And that's really hard because we have trillions of dollars of corporate debt that have to get refinanced in the next 5 years, 60 months. So, and the cost of capital being so much higher. So I would love to say that earnings season and everything is going to be this soft landing and this great recovery for 2022. But I am seeing all of the economic data and indicators showing us recessionary, depressionary times coming. And I don't want people not to have heard that message on Wall Street. They need to have heard that from somewhere.
Rebecca, right now, with the auctions this week on the Treasury coming, what role is that playing? Because when we talk about recessionary or depressionary conditions, sure seems odd to see Treasury yields rising. What do you attribute that to?
Well, I mean, think about it, Oliver. If you have a currency shift, if you have a global macroeconomic shift from dollar hegemonic status to multipolarity, with the BRICS nations potentially offering a global reserve backed by gold, has been mentioned by several of those blocks. If you have that, then you have less confidence in the future of the G7 nations to be able to actually deliver on their sovereign treasury debt, their sovereign paper that they're issuing. So you start to expect and demand a higher yield. With the Fitch downgrade last week, I mean, what are we expecting? It's going to cost us more now to attract the same amount of capital. Our country is more expensive, and yet do you see Wall Street, or do you see Washington rather, changing any kind of spending of any kind and recognizing that, hey, we've got some problems? So I worry about the G7. And Oliver, if you start to see no bid, if you start to see auctions push back, if you start to see auctions that go really badly, all of these things, again, would be further indication. But of course, it's going to cost us more now to attract the same capital as before, because now we're even more risky. We're more risky even with our own rating agencies, but we're more risky globally. And so is the G7.
Okay, so if we got economic data pointing us towards slowdown and too much debt to issue to keep yields down, what do we do, Rebecca? What do we buy? What are we supposed to do with our money?
Yeah, so I would say any kind of financial derivative product, which obviously equities and bonds are financial derivatives, that rely on the bearer, the corporation, to have value and to continue to have value as a going concern. And obviously the issuer of the bond to be able to continue to honor that paper and that debt and service the interest and pay the actual debt repayment. So when you're concerned about those kinds of things, the financial derivatives need to be shifted to more hard assets with intrinsic value. Obviously, people immediately jump to real estate because of the land, the brick and the mortar, which I wouldn't discourage, although commercial real estate has got its own massive major problems. So our real estate is going to have it. I believe it's completely overpriced, and it's going to come down with especially with these mortgage rates coming so high. But really, Oliver, it's the commodities that are currency based, gold, silver, your hard assets are really going to be, if we truly are going through a global economic dollar hegemony ending stage de-dollarization, where we're going to have the dollar's not going to be gone. We're still going to have the dollar, but it will not be the sole reserve. If that's where we're headed, then hard assets would be the play in that kind of transition.
Okay, so sounds like some real estate maybe once prices normalize, some gold in there perhaps. What about other commodities?
Yeah, I mean, I think there's a lot of things. A lot of people are really looking at Bitcoin and cryptos. I do think there's been some proof of concept of store of value through all of this since 2020, Oliver. But, that's still being attacked aggressively in the United States by regulators. And it's being attacked globally by regulators in Europe as well. So I think that obviously for these governments to move to central bank digital currencies, which would be a central bank blockchain based currency, they can't have really these alternative non-government operating and controlled crypto. So I still really worry about people using the crypto market space because of the government regulation. But otherwise, that potentially we've seen some proof of concept of store of value on a blockchain that can't be manipulated by the government. Okay.
All right. We are warmed up and awake now, Rebecca. Thank you very much. Appreciate the start to our session here. Absolutely. Rebecca Walser, president at Walser Wealth Management. All right. A note of concern for sure about the economy and our ability to issue the debt as well.